All right, let's get right into it. If you glanced at the Japanese stock market today, you probably saw a sea of red. Just a really sharp, sudden drop that felt like it came out of nowhere. Especially because, let's be honest, Japan has been one of the absolute star performers this year. So, what on earth just happened? So, yeah, that is the big question on everyone's mind. It feels confusing, right? A little chaotic, even. But stick with me here, because by the end of this, you're going to have a really clear framework to understand not just what happened today, but also what might be around the corner. And this right here is the paradox that's so jarring. I mean, look at the year-to-date performance. The Nikkei was a global leader, just crushing it. But today, the story completely flipped. Japan took the biggest hit of them all. And that disconnect, that's exactly what we need to figure out. Okay, to make sense of all this, here's our quick game plan. First, we'll nail down the details of this shock. Then, I'm going to give you a super simple 4-layer analysis tool that cuts through all the noise. We'll use that tool to decode what just happened. Then we'll look at the short and midterm outlook. And finally, we'll put together a clear strategic playbook. Let's do it. You know how it is. Whenever there's a big market move, the headlines just scream a dozen different reasons at you. It's more noise than clarity. So we're going to use a structured framework to slice right through it. Think of it as kind of like an X-ray for the market. And this is that tool, the 4-layer analysis. It's really just a systematic way to diagnose what's happening by looking at 4 very specific areas. It helps us ignore all the shouting and find the real source of the pressure. And here they are. First, there's the market layer itself. This is all about sentiment, fear, greed, pure investor behavior. Second, we have policy. What are the central banks and governments up to? Third, there's trade. Is the global economy humming along or is it sputtering? And finally, geopolitics. Any big external shocks hitting the system. All right, let's put this framework to use right now. So let's take our new tool and apply it directly to today's market shock. We're going to go layer by layer and pinpoint exactly where that stress is coming from. And whoa, okay, this chart tells us almost the entire story in one glance. These bars show the stress level in each layer. And just look at that. The market layer is lit up, showing a stress score of nearly 1.8. It is overwhelmingly the source of today's drop. The other layers? They're basically flat. This tells us something absolutely crucial. This was not an economic crisis. This was a market-driven event. Okay, so let's drill down into that market layer. The trigger was something analysts are calling a reverse rotation. Basically, all those high-flying AI and semiconductor stocks that have powered the market up all year long, well, they suddenly had a huge wave of profit-taking. It seems to have started with a similar move in U.S. tech stocks, and then Japanese investors followed right along, deciding it was time to cash in their own pretty significant gains. And you can see just how much fear that rotation caused right here. The Nikkei Volatility Index, which is basically Japan's own fear gauge, shot all the way up to 35. Now, for context, anything over 30 is considered the danger zone. This just confirms it. This was a pure, sentiment-driven, fear-driven sell-off. This wasn't a slow grind down based on bad economic news. Now, moving to our second layer, policy. We can see that while it wasn't the main driver today, there are definitely some important shifts happening just under the surface. The financial environment is being described as becoming slightly tight. Now, it's not a crisis, not at all, but it is a sign that the era of super easy money is slowly but surely fading away. The situation with the yen is a perfect example of this complexity. I mean, right now, at 154 to the dollar, the weak yen is a massive boost for Japan's big exporters. But the market is starting to worry about what's next. The potential for the Bank of Japan to raise rates could make the yen much stronger, and that risk is starting to get priced in. It's a classic push-pull dynamic, a real tug of war. On to our third layer, trade. Here, we're seeing some mild headwinds. Recent data out of China and other parts of Asia is pointing to a bit of a slowdown, which isn't great for an export-heavy economy like Japan. But let's be really clear, this is a mild headwind, a slow-burning issue, not the cause of today's firestorm. And finally, geopolitics. Look, there are always major risks simmering in the background, like conflicts and trade tensions. But were there any new geopolitical shocks today that could explain this specific drop? Nope, nothing. So we can safely say this layer was neutral. So our 4-layer analysis tells us this was a sentiment-driven correction, happening almost entirely in the market layer. Okay, great. Now what does that actually mean for the future?
Let's move from diagnosis to prognosis.
So here's how things seem to be breaking down. In the short term, you might want to buckle up. The next few weeks could stay pretty choppy, with more profit-taking in tech and maybe a rotation into safer, more defensive stocks. But, and this is the key part, if you zoom out to the medium term, the fundamental growth story for Japan hasn't really changed. Major firms are still forecasting the Nikkei heading up towards 50,000 by the end of 2025.
And honestly, this quote from the source analysis just captures the situation perfectly. The structural bull story remains, but cyclically, we are in a correction phase. In other words, the big picture, the long-term positive story is still intact. We're just hitting a necessary and, painful bump in the road. Which of course brings us to the most important question of all. So what do you do with this information? Let's build a clear, strategic playbook based on what we've just figured out. The analysis really points to two potential paths here. First, if you're a long-term believer in the whole AI and semiconductor story, well, this dip just means high-quality companies are on sale. Their valuations just got a lot more attractive. The second path is for those who might be a bit more cautious. You could look at domestic, defensive companies that are more stable and better shielded from any of those currency swings. But, and this is a really crucial word of caution, as long as that volatility index, that fear gauge we saw, is in the danger zone, it's probably wise to be careful. This is not the time to be a hero. It means avoiding the super speculative stuff or those leverage products that can multiply your losses just as fast as they multiply your gains. So we end right where we began, but now we have a powerful framework to actually answer the question. Is this a market breakdown or is it a rare buying opportunity? Our four-layer analysis strongly suggests it's the second one, a painful but temporary correction driven by market sentiment, not a fundamental collapse in the underlying economy. And now you have the tool to see that difference for yourself. Thanks for joining me.